Safe investments are not relevant anymore.
I stopped investing in stocks.
Owning real estate is grossly disadvantaged.
I'm going to teach everyone in the world that they should stop saving money.
Well, at least many people say that safe investments don't work nowadays. Some investors back off from putting their money into real estate or index funds. Many believe that it is impossible to build wealth through these assets now. So, should we avoid them? Perhaps it is time to save your money under the mattress or even switch over to crypto. Let's not jump into conclusions, and let's figure out why in the world more and more people avoid investments that were believed to be safe for decades. The term safe investments refer to low-risk financial assets that are unlikely to lead to significant capital loss. These investments are more stable, so they are the best option for conservative investors. Examples of these include real estate, index funds, and savings accounts. These options may offer lower returns compared to riskier investments, but instead, they provide more security for the invested capital. Still, many people wonder whether those safe investments are secure and effective anymore. For example, some believe that savings accounts only make you lose money. This usually happens because their returns are lower than the level of inflation.
I have decided to stop saving money. Yeah, saving money is a total scam.
Others say that real estate isn't a good investment anymore because of the current sky-high prices and the increasing mortgage interest rates.
By its nature, real estate tends to be a very lousy investment.
Some believe that investing in the S&P 500 won't make you wealthy anymore. Why? Because too many people are investing in it, and many claim that its value might not go much higher in the future, meaning that investors won't earn a lot, even in the long run.
You can't make money investing with index funds.
But is it all true? Let's figure everything out step by step. Let's start with real estate. By 2030, the global real estate market will hit nearly $5.8 trillion. Nowadays, the US has the largest share of global real estate market. And in 2020 alone, the sector got over $1.5 trillion in revenue. Nevertheless, people today are in no hurry to sell and buy houses.
2023 could go down as the tightest inventory market conditions to have ever been recorded.
We saw the buyers pull back initially when the interest rates were much higher.
In the US, individual investors handle around 70% of rental properties. This is a great indicator showing that Americans love to invest in real estate. Yet, it gets harder and harder due to insufficient supply and growing prices. It happens largely because of the economic conditions, a greater number of investors and more people wanting to live their American dream. But the prices also increase because the homes are getting bigger. Imagine that from 1970 to 2017, the size of an American house grew by 73%. And on top of that, now people don't want to sell their homes to avoid losing low interest rates on their mortgage. If they sell, they will want to get a new place, but it will come at a new interest rate, which is now much higher compared to the near zero rates we saw during the pandemic times. That's why the number of houses for sale is down. Today, real estate investors face many issues related to property costs, yet it doesn't mean real estate has no opportunities left for its investor. So what's the reality of investing in this sector now with high mortgage rates, insane prices, and very few options on the market? Real estate was always less liquid than many other investments, especially now. Liquid investments are valuable because you can sell them fast if needed. Take stocks, bonds, gold, and silver as examples. You can easily convert them to cash. But what adds to the issue is that often those who invest in real estate are middle income group. And it isn't a bad move because it is a safe and reliable investment that compounds its value over time. Still, if a person needs money urgently, selling a house can be quite challenging, especially during downtimes. That is why it is so important to diversify your investment portfolio and allocate at least some money to the asset that you can quickly convert to cash. But again, This doesn't mean you have to stay away from real estate, because even the richest people often start building their wealth with this type of investment.
We've both had a fair amount of experience in real estate, and Charlie made his early money in real estate.
And the best thing about housing is that even in times of economic turbulence, real estate investors still profit from rental income, property-related businesses, and value appreciation. Property values usually rise in the long run, allowing you to make gains when selling. When you're paying off a property mortgage, you also build more equity and increase your net worth. This helps you buy more properties or other assets thanks to its appreciation. Besides, when rents increase, property owners get more cash flow. And because people still need to live somewhere, this type of income really doesn't die.
Occupancies, rents, and they are as healthy as they've ever been.
Real estate is not only illiquid, but also has opaque pricing, meaning hidden pricing. Unlike stocks and bonds, real estate listings often differ from actual transaction rates because buyers struggle to determine the accurate buying price. And if we are facing time of crisis or a slower economy, it gets even worse. That's something we can observe now. After the record prices in 2022, the market is a bit lost as many investors don't understand what to expect from real estate in the face of a possible recession. Yet, at the same time, real estate serves as an inflation hedge due to its link between gross domestic product growth and demand. That's why, even though the inflation level now is one of the highest in decades, people are still looking into buying properties. Because investors understand that growing economies have a higher real estate demand, and the American economy will start to grow again sooner or later. This will eventually lead to higher rents and property values. So even though many keep saying that real estate isn't a good investment now, the facts show the opposite. The real estate value increases over time, providing potential appreciation. While serious crises like the 2008 housing crisis are uncommon and the market recovers anyways, still, some tactics that were loved by investors for years aren't really that effective anymore. What are those? Take house flipping, for example. House flipping got famous several years ago. In 2017, 5.7% of home sales were flipped, but this number increased by 40% in just 5 years. Despite its popularity, house flipping is less profitable today. In 2017, the average return on investment was 51% with a $65,000 profit. But by 2020, the flipping rates decreased in most American local markets. And this downtrend continues until today, which many say it's another proof of the housing market cooling down. So why doesn't house flipping work as it used to? First of all, house flipping costs got costly because anyone who has been looking to buy a house lately knows that affordable properties are scarce. That all happens due to high demand and limited supply. In pricier markets like New York City or California, flipping isn't just challenging, it's nearly impossible. The main reasons for that are high prices and market unpredictability. Besides, house flipping is risky because of its short-term nature. It involves purchasing properties quickly, renovating rapidly, and selling for profits within months. Success is uncertain because you might face unexpected costs, resulting in potential losses. Besides, house flipping isn't as easy as it might seem on renovation TV shows.
Flip was completed in 5 weeks and sold within 4 days of being on the market.
Something like this is so often so far from what investors face in real life. Quick renovations are usually demanding and costly. Besides, budgets and timelines often end up changing and postponing, even with experienced contractors. And unfortunately, no matter how good you are at DIY, those skills might not be enough, or it will take way too much time. One more important factor flippers have to consider is buyers' preferences and market segments. If you want to resell your renovated house to high-end buyers, your cost-effective finishes might not work for them. And if you're focusing on entry-level homes with standard finishes, you might not make as much profit as you expect because people's budget for their first home are usually limited. So, as you see, house flipping is less popular and profitable today for numerous reasons. But many experts still say that it is a good time to invest in rental properties, especially residential ones, because the demand for rent is still high and doesn't seem to slow down anytime soon. Now, as we've seen what's going on real estate lately, let's talk about another safe option for investing: index funds. Should you still consider them, or is it better to avoid them altogether? Index funds have offered high and stable returns for decades. Still, can we expect this to continue the same way? Many say that the golden times are over, even for the S&P 500. Is it true though? If we look into the essence of the S&P 500 index funds, it unites 500 major US publicly traded companies. That's why it doesn't only represent the stock market's performance, but also the state of the American economy. And the issue I see with the statement that the S&P 500 golden times are over is that it might well mean that the golden times of the American economy are over as well. And this statement is way too extreme because nothing indicates something like that at this point. The S&P 500 began in 1923, and it exists until now, having around $1.3 trillion in net assets. In the last 30 years, the S&P 500 increased about 10.7% yearly, which is a very good return, especially for a relatively safe investment. That's why many experts with great experience and reputation still recommend investing in index funds.
Why have you advised your wife to invest in index funds after your death rather than Berkshire Hathaway?
Warren Buffett, the billionaire investor, believes that an S&P 500 index fund is the best investment choice for most people. He even recommends his wife to invest in this fund after his passing.
I'd probably have it all in a very low-cost index fund.
Besides, there's a really important thing we can't ignore. Even professional investors can't beat the S&P 500, and this is a fact.
95% of the people have almost no chance of beating it over time.
So if you and I start guessing which company will perform better, we'll most likely lose, unless we get lucky. Even Warren Buffett himself says that he cannot beat the market. And he is literally the most famous investor of all. But even despite all this, more and more people are backing off from investing in the S&P 500 index funds. Why? Well, the first reason not to invest in index funds is less downside protection. While the stock market has long-term potential, it comes with its shares of ups and downs. Index funds like the S&P 500 offer gains during market highs, but expose you to downturns, and lows will always be there. Investors can hedge by shorting S&P 500 futures or buying put options, but these strategies might be risky and really complex. The second reason why some advocate to stop investing in the index funds is their limited reactivity. Index investing is less flexible. When a stock becomes overvalued, it gains more importance in the index, and you can't control it, which brings us to the next issue: limited portfolio control. Index funds offer predetermined holdings. When you invest in an index fund, you can't control the individual asset in the portfolio. This lack of choice doesn't let you target individual companies that stand out to you. At the same time, index funds investing also brings many great things. For example, cost advantages with lower management fees and potential tax benefits. Index fund investing also provides strong returns. While individual company stocks vary, the market generally grows over time. Index funds offer high returns at a low cost, making them a valuable choice for investors, especially as an addition to your diversified portfolio. Besides, investing in index funds gives you an instant diversification, which reduces the risk of significant losses. Because in the end, you invest in 500 companies in 11 sectors. Despite individual stock fluctuations, the fund's performance is remarkable in the long run, and this nature gives you greater stability, which is important for any investor. Index funds also allow passive investing. Warren Buffett even recommends index funds as a secure option for retirement funds. It's almost a passive investment that doesn't need constant monitoring. That's why by investing gradually over time, you can enjoy long-term benefits.
S&P algorithm is very hard to beat.
Finally, index funds are open and unbiased investment options. They are rule-based and automated, minimizing bias or human influence choices. Yes, index funds have their drawbacks, but as you see, investing in them still has enough benefits to continue to do it. So, we'll double check the relevancy of index funds, but what about money savings accounts? Today, many believe that they are not effective anymore. Spending less than you earn is key, but just saving isn't enough. Putting your money to work through investing is essential for building wealth. Saving doesn't shield you from inflation or economic changes.
Why I think that saving money doesn't really work.
I'm going to say something quite controversial. Stop saving your money.
Money's values drop over time. $1 today won't buy you as much in a decade from now. For example, $10,000 30 years ago had the same purchasing power as almost $20,000 today. During this time, the average annual inflation rate was 2.5%, causing prices to rise by almost 120%. This means that the prices we have today are about 2 times higher than those 30 years ago. This shows how the real value of the US dollar decreases over time, resulting in fewer items it can buy. That's exactly how inflation gradually erodes the value of dollar over time. That's why savings does no good to you. But what about savings account then? They do pay some interest rates, right? Yes, but this interest rate is so ridiculously small that it won't even cover you from inflation. Instead of earning, it makes you lose money. We've discussed this in detail in this video, so if you haven't watched it, feel free to check it out after finishing with this episode. As you can see, some money investing strategies like house flipping and putting your money into savings accounts are not relevant anymore. At the same time, some others, like real estate or index funds, still bring a great stable profit even despite the cons that many are actively talking about. But again, keeping your savings under the mattress or investing in index fund and real estate is all up to you. What are your thoughts? Share them down in the comments below. See you in the next video. Bye-bye.